So recently the market has seen some turmoil due to various factors. There are plenty of videos out there telling you what exactly is happening. If you're watching this video in August 2024, you know it's crazy out there right now. However, if you're watching this video during a different market crash, you'll still find this video to be quite helpful. Let's begin. So before I get to how to handle a market crash, I want to start by saying that no matter when you start investing or how long you have been invested for, it doesn't matter. You're bound to find yourself in the middle of a market crash and of course bear markets. This could be happening because of many different factors. It could be because of a war. It could be because of a country that's not even yours. It could be because of several macroeconomic factors, and sometimes it can just be a completely unforeseen event of any of these kinds or beyond. What I want to do in this video is to cover some do's and don'ts during a market crash or a general downturn. Over the course of our investing journeys, we'll find ourselves in similar situations many times, so it's important to understand how to handle them. And it goes without saying that nothing in this video is financial advice and is for informational purposes only. Firstly, when something like this happens, the most important thing is don't panic. Yes, during a market crash or the course of a bear market, it's very natural to feel panic and uncertainty. Now, no matter how experienced you are, you're bound to feel some level of panic. Even for me, 5 days ago when the market started crashing, I was feeling some sort of panic. Even though I was prepared for it, I still didn't feel very good about it. Over the course of my investing journey, I have started feeling it lesser and lesser, but it still comes about quite often. If I looked at my panic levels now and compared it to 2020 or 2022, it's not as bad anymore. Generally, seeing the value of your investments plummet can be emotionally devastating, and media coverage often fuels anxiety with sensational headlines and doomsday predictions during these times. And it's the fear of further losses that can tempt you into making impulsive decisions. But remember, it's crucial to resist the urge to panic and make hasty decisions with your portfolios. You know about panic selling. It's one of the most common things that we see during a market downturn, and it's also one of the worst things that you can do with your portfolio. Just look at the 2008 financial crisis. Those who sold during these times missed out on the subsequent bull market. More recently, a lot of people sold out of really good assets during the 2022 market downturn. And now just look at some of these stocks. They have gone on to make new highs over the last 1.5 years. As Peter Lynch said, far more money has been lost by investors preparing for corrections than has been lost in corrections themselves. Now it's quite easy to understand why panic selling is a bad thing. If you just look at some data, you'll understand why you should try to avoid panic selling during market downturns. On the flip side, it's also important to understand why panic buying is a bad thing for you. Sometimes when you're panic buying, you're trying to catch the bottom by going all in on a risky asset, and it can backfire if the market continues to fall. When you find yourself panicking in a market downturn, you really need to understand what is the exact reason you're panicking. Sometimes the reason could be that you are overextended in the market. You have invested more money that you can afford to lose. You should not be in this situation. There are lots of people out there who invest all their money. They're not even keeping an emergency fund. Remember what Warren Buffett says: the first rule of investing is to never lose money, and the second rule of investing is to go back to the first rule. So just by virtue of that, you should not be investing your emergency fund ever. There could also be some other reasons that you're panicking. One of them could be that you have mismanaged risk. You couldn't figure out your risk tolerance, and now you're taking on more risk than you can actually stomach. It could also be that you're not well diversified and you're seeing more losses than the average person is seeing out there, and it's causing you to panic even more. And finally, it could just be that you haven't taken the time to really understand what's going on in the market. Most of the things that happen in the market are short term and not long term things. So before you start panicking, really understand what's going on in the market. Understand what's going on with you, your emotions. Then understand what's going on with your portfolio, and then take actions without panicking. Talking about risk tolerance brings us to the next thing that you should do to handle the situation well, that is to assess your risk tolerance. So I'd briefly mentioned that the reason you might be panicking is because you might have taken on too much risk, and honestly it's a good time to evaluate how much risk you can handle. Remember, stock market crashes occur every 7 to 8 years on average, with an average decline of around 20 to 30% over a period of 1 year. Individual stocks can crash even more, so it's important to understand how much risk you can take. Can you really afford to put in all this money and see it go down 50, 60, 70% in case the worst thing happens? If not, try to keep a balanced approach and try to stay invested in the S&P 500 as much as possible from a long-term viability point of view. If you're young with a long investing horizon, you can likely afford to stay aggressive. But if you're nearing retirement, consider dialing back on your individual stock exposure somewhat and stick to safer investments. The key is to have a balanced, diversified portfolio that aligns with your risk tolerance and goals. Recently, I realized that a lot of positions in my portfolio are going way lower than the average decline. This has led me to reassess my risk and change my future plans to rebalance my portfolio better. By the way, if you're enjoying the video so far, hit like and consider subscribing. I post videos every Friday and I would love for you to watch them. So, talking about rebalancing our portfolio brings us to the next point, that is, you need to look for the right opportunities. Warren Buffett famously advises to be fearful when others are greedy and greedy when others are fearful. While you may be feeling the worst during a market downturn, it also presents the best buying opportunities. To make this point, I want to show you two different scenarios. After the 1987 Black Monday crash, stocks fully recovered within 2 years. $1,000 invested in the S&P 500 at the low would have grown to over $20,000 today. And similarly, $1,000 invested in the S&P 500 at the 2009 bottom during the global financial crisis would be worth over $7,000 now. So as you see, if you keep a long-term horizon and keep investing in good assets, you're going to come out on top winning. So here are 4 things that you should be doing. First is to understand where you are with your portfolio today and where you want to go with it. Second is to find quality assets with quality fundamentals. The third is to start dollar cost averaging into them over a period of time, especially during the bear market. And the fourth one actually brings us to the next point, that is, you must diversify smartly. The value of diversification cannot be overstated. This is something I'm guilty of too. I'm very concentrated in very risk on assets and I'm suffering. I'm trying to get better at it and you should try to aim for that as well. Just look at the 2000.com crash and the 2008 financial crisis. It showcased the dangers of being overly concentrated in frothy sectors. For all we know, the frothy sector right now is AI and we are all overexposed to it. Diversifying across asset classes, sectors, geographies, and risk profiles is crucial to mitigating losses during crashes. There have been times when a 60-40 stock bond portfolio would be down about 12% compared to a 20% for an all stock portfolio. Holding some gold, cash, and defensive sectors like consumer staples and healthcare also tend to help in crashes. Personally, I have weathered some storms by staying invested in dividend stocks and making some money even during a bear market. But at the same time, during a bear market, sometimes I sell things at a loss just to move into other assets just to create a better diversified portfolio. Remember, if 2 stocks are down 50% and you think moving out of one and moving into another is going to give you better diversification and better chances of surviving a bear market, you might want to do that. Your final goal should be to build an all-weather portfolio that can withstand different market conditions over a long period of time. Now, it goes without saying that you should never go all in on one asset. Never become an all-in Tesla investor or an all-in Bitcoin investor. You need to not just look at the upside but also the risk that comes with the upside. You need to always look at the risk reward curve when taking decisions. So if you're going through a market downturn right now, take the opportunity to re-diversify, rebalance your portfolio, and just make sure that you can survive these times. At the end of the day, there's only one thing that you can truly do, that is control what you can. So this is the last point I wanted to talk about. It's very much about the market psychology and how you behave in it. Remember, we can't control the markets, but we can control our own behavior. In a very recent video of mine, I talked about some stoic principles that you might want to adopt when it comes to money management and investing. One of the key points that I mentioned in that was to make sure that you try to control the things you truly can control and let go of all the things that you can't. For example, the most obvious one, you can never control macroeconomic factors. What you can do is prepare yourself for bad times, and everything that we have discussed in this video so far should help you do that. However, here are 6 points that I really want to share with you. First, stick to your long-term investing plan and avoid trying to time the market at all times. Keep dollar cost averaging into the market even when it's painful. I use a very common example to illustrate this. If you were to invest $200 every month into the S&P 500 over the course of your life, you will come out on top becoming a millionaire. Remember, a lot of money has been lost trying to time the market compared to people who just dollar cost average without worrying about when they're buying their assets. What you really need to do is catch some of the best days in the market, which you can never time, so why worry about it? Just keep investing regularly into good assets. Thirdly, tune out media noise and doomsday predictions that can cloud your judgment. I've actually made a full video on why you should never listen to mainstream media when it comes to investing. Feel free to check it out. The fourth one is to ensure that you have adequate emergency funds so you're not forced to sell investments at a loss. This is something that I spoke about earlier in this video, and here's a quick reminder of how much money you need to have in your emergency fund. The fifth one is to take care of your health to keep stress and emotions in check. Remember, your health is really important. Now, I'm not going to say something cliche like health before wealth or any of that. But to take investment decisions, you need to have mental clarity. And to have mental clarity, you need to be in good health. And finally, consider consulting with a trusted financial advisor if you need guidance. So I don't have a financial advisor right now, but I know a lot of people require financial advisors. The only thing that I'll say is that go for a good one and make sure that they have a good and proven track record of helping people out. So those are some of the things that you can do during a market crash or a market downturn. I know market crashes are never fun and it's never easy either, but you can come out on top making a lot more money if you just take the right decisions during these times. I just want to remind you that market crashes are a normal part of the investing cycle. Since 1929, the US has endured 12 bear markets where stocks fell over 20%. And still, $1 invested in the S&P 500 in 1926 would be worth over 13,000 today. Because over the long term, stock markets tend to constantly keep going up. The overall lesson here is to stay level headed, stay diversified, and stay in it for the long term. And if you're in the middle of a market crash right now, just remember that this too shall pass. Markets will eventually recover as they always have. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.